just to start off, we really do appreciate everybody who's called in to kind of learn a little bit about what's going on in the market with growth, performance, movement, etc. If you can't stay on for this entire webinar today, we are recording it and we will put it online and host it on our website. We'll shoot out an email to everybody letting them know that where the file is, where they can watch it, all that good stuff. So just a little bit about state of the markets. This is a great presentation that's been put together because oftentimes when we look at any account, your performance, whatever it would be, figuring out what performance you posted is one thing, but really understanding what the heck happened and why it happened in the markets is something that's completely different. So we always want to offer up this kind of education to our clients who seem to be interested in knowing what the heck happened and what we could expect. You know, this year so far, we've already had some turbulence, and we'll chat about that towards the end. But it all goes back to you looking at what's going on in the market, what's driving everything that's happening. So we really feel like that's something that's important to tell all of you. Now, we're going to mute everybody. We're not going to take questions throughout this State of the Markets presentation. We imagine that some of you who are calling in might be on your lunch break, whatever it would be. So if you have questions that pop up, concerns, anything like that, please feel free to give our office a call. We're always more than happy to chat about whatever it is. So with that being said, I want to introduce Drew Albers, who's going to be kind of running this presentation, and he'll do a great job. So kick it off, Drew.
Thanks for the kind words, Colby. And thank you guys all for jumping on this today. Hopefully you find some of this information relevant and useful as we go through it. So that being said, let's take a look here and get everything started. So the first slide of the presentation, I'd like to just draw your attention to this to keep our regulators and attorneys happy. Everyone got it? Great. All right, so we know that the financial world is incredibly complex, and these days we're all bombarded with dramatic headlines and contrasting opinions. So our goal today is to educate you about some of the factors we and expert financial analysts are watching. Of course, it would be impossible for us to cover everything, but we will try to touch base on the most relevant factors. And while past performance does not guarantee future results, we feel that we can focus on the trends today, and that's going to help guide the decision-making process when investing. So here's what we're going to be talking about today. What happened in 2017, what other factors affected the markets, what's on the horizon, and finally, what do financial experts forecast for 2018? So let's start off by taking a look at how we can put last year's stock market performance into perspective. In 2017, markets soared to new highs on solid economic expansion. The S&P 500, Dow, and NASDAQ all repeatedly broke new records. And with record low volatility, the bull market just kept charging. President Trump's inauguration in January further encouraged the already growing markets. The solid market performances also helped push the Federal Reserve to raise interest rates 3 times throughout the year. During the summer, some investors expressed concern over key events, Hurricanes Harvey and Irma, and rising tensions between the US and North Korea. A focus on market fundamentals became crucial. So keeping this in perspective helped investors to capitalize on the economy's upward momentum. In December, the House and Senate reached an agreement on a tax reform bill that supporters claim will help boost business and boost the GDP. And on December 22nd, President Trump signed that bill into law. Finally, despite posting losses in the year's last trading week, all major domestic indexes still ended 2017 far higher than where they began. At the end of 2016, well-known analysts gave their predictions for the S&P 500's performance in 2017. They all predicted that the index would grow, but even the most optimistic target was still more than 200 points below the actual results. Ultimately, the S&P 500 went far beyond expectations to close the year with a 19.4% gain. And the S&P 500 was not the only domestic index that performed well. The Dow increased by 25.1%, and the NASDAQ was also up by 28.2%. So we've seen that 2017 brought significant growth to the markets, but let's dig a little bit deeper at some of the factors that contributed to the performance last year. That would be the labor market, housing, consumer spending, corporate growth, and inflation. 2017 was a solid year for American workers. The unemployment rate dropped to 4.1%, which was the lowest rate since before the dot-com bubble. And in December, we hit the 87th consecutive month of job growth. So while the labor market experienced some volatility due to Hurricanes Harvey and Irma, the unemployment rate remained at a 17-year low. So with that said, wage growth has been relatively sluggish, hovering at about 2.5% in an increase for the year. Understanding the scope of growth in the labor market and where the jobs are coming from can be very eye-opening. The total private payroll chart reveals that the economy lost 8.8 million jobs during the Great Recession. During the recovery, we've gained back twice as many, with 17.1 million new jobs created between 2010 and 2017. So where did those jobs come from? Industries related to information, financial services, and professional and business services gained 5.1 million jobs. And on the other end of the spectrum, we lost about 100,000 government jobs compared to February of 2010. 2017 also gave us a lot of positive insight when it comes to home sales. The last data available in 2017 comes from November, and it indicates that the industry is performing very well. In November, both new and existing home sales were the highest they'd been in at least a decade. Year over year, existing home sales were up 3.8%, while prices increased by 5.8%. And in that same time period, new home sales jumped to a massive 26.6%, while prices grew a more modest 1.2%. So even with this huge jump in new home sales, they still represent a lower percentage of home sales than in the decade before the housing bubble burst. So in other words, new home sales may still have some room to grow. And in fact, some analysts believe that new home sales still have a good bit of growth potential, which would also benefit the home building industry. Overall, as the economy picks up speed, the housing industry is helping to foster that growth. Consumer spending accounts for more than 2/3 of GDP. So the health of the individual's financial lives is an important facet to understand when analyzing economic strength. And judging from recent data, consumers are starting to feel the effects of economic growth and increase their spending in response. As of reports from December 2017, consumer spending had increased 4.5% year over year. Incomes had also gained 3.8% from the same time in 2016. Now, this chart is going to give a month-by-month breakdown of how much consumer spending and personal income have increased in recent months. With the exception of personal income staying flat in June 2017, both measures have been on the rise year over year. But as November's data does give us one potential challenge to be aware of, and that spending is increasing faster than incomes. And as we all know, spending more than you can make can be a recipe for debt. Currently, the debt-to-income ratios are near their lowest rates they've been in the last 35 years, but this is one detail that we will continue to pay attention to as 2018 progresses. In 2017, businesses continued to grow on what we've seen for the past several quarters. Now, during the third quarter earnings season, which is the last quarter that we have data for, 72.8% of companies in the S&P 500 had beat their earnings expectations. And 68.1% beat their revenue expectations as well. Overall, analysts are anticipating that these earnings will be 8.4% higher than the same time last year. And while data for the final quarter of 2017 is not yet available, the estimated earnings growth is even higher, between 10.6 and 11.6%. So if we look at this chart, you can see that the corporate earnings have grown since the third quarter of 2016. Analysts at Thomson & Reuters expect them to keep rising at least through the second quarter of 2019. So let's talk about inflationary trends for a moment. Inflation is a general rise in the prices of goods and services, and one of the key indicators of economic well-being. And though the relationship between inflation and stock market performance is complex, generally speaking, stable, moderate inflation is better for equities than higher volatile inflation. If you take a look at the box in the middle of this chart, you'll see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The federal government puts out this data and tracks price trends in a large number of goods and services bought and sold throughout the United States. The core CPI below it strips out volatile food and fuel prices to just focus on long-term inflation trends. So you can see that the brown CPI line jumps around a lot more than the yellow core CPI line, and that's because the food and energy prices tend to be very volatile in the short run. So the past doesn't always reflect the future. Historically, a sudden run-up in prices is often presaged or accompanied a recession. Note the huge inflationary spikes in the 1970s oil crisis and during the 1980s recession. Right now, the 2.2% headline CPI as of November 2017 is well below the 50-year average. In addition, the core PCE deflator, which the Federal Reserve uses as a primary inflation measure, was also less than half of its 50-year average. And at 1.5%, the core PCE deflator is also below the Fed's 2% benchmark. The Fed has a mandate to foster maximum employment and price stability, and they believe that a 2% rate can help support accurate financial forecasting and decisions while also preventing harmful deflation. We're confident that the U.S. economy is on the right track, yet we know that the stock market does not always follow the economy. One major indicator of economic health is consumer sentiment. Essentially, this is a survey that asks regular Americans how they feel about the economy and their financial prospects. It's an important indicator because sentiment has a strong relationship with consumer spending, and consumer spending drives 2/3 of economic growth. Sentiment can also connect to market performance, but in more complicated ways than you may expect. Consumer sentiment is typically a rational reaction to a strong economy. However, it can also signal irrational investor exuberance when prices climb to unsustainable levels. Historically, recessions sometimes follow periods of high consumer sentiment, and we see those recessionary periods on this chart as vertical shaded areas. Is that always the case? No. We can see that it wasn't the case in 1977, 1984, or 2004, but it did happen in 1972, 2000, and 2007. In October of 2017, consumer sentiment hit 100.7, which is the highest reading since 2004. Though consumer sentiment fell to 98.5 in November and 96.8 in December, it still remains in positive territory. Household finances helped raise consumers' attitudes on the backs of a strong economy, low unemployment rates, and market highs. Before we look forward, let's take a look at the past. Last year we imagined potential headlines that could happen in the future and gave both optimistic and pessimistic scenarios. From a positive view, we imagined that the stock market would perform well, businesses would invest in the U.S., and President Trump's economic policies would help accelerate the economy. And we're happy to say that these positive predictions did come to be true in 2017. The market continues to hit new record highs, and new economic and tax policies have helped drive business. Thankfully, the potential risks we identified in 2017 never manifested. The European Union is still intact, we've avoided potential trade wars, and inflation remains low. So by following market fundamentals and avoiding knee-jerk reactions, emotional decisions, we maintained an optimistic outlook throughout last year. So we've looked at some of the factors that affected market performance in 2017, and now we want to take a look at and examine the headwinds and tailwinds that could affect the speed and trajectory of economic growth in the near term. 2018 is going to bring new questions about what the future may hold. If tensions with North Korea ease and the European Union continues to strengthen, new international opportunities may become available. And since the tax reform bill became law, Republicans are promising economic expansion. In this case, we might imagine future headlines touting major accomplishments a few years from now, such as the new tax bill spurs economic growth, or tension with North Korea eases, or European continues to strengthen despite Brexit. And on the other hand, we could have a different picture 5 years from now. If some of the potential risks and headwinds catch a hold of our economy, the outlook becomes more concerning. Ultimately, no one can predict the future, and 2018 brings a noteworthy amount of political uncertainty. We believe times like these are when you have to focus on the fundamentals and avoid focusing on emotions. So we must look at what's really happening in the economy and what the data is showing us. Whether it's real or imagined, headlines are only helpful if we take the time to think critically and look for truth amid the hype. So, if a recession often triggers bear markets, do we have to worry about a recession this year? I want you guys to take a look at a group of indicators that can help ground our prediction in data. This slide takes us back to December of 2008. So here we see a group of 20 indicators. Now these indicators help forecast pressures on the economy and financial markets in the next 3 to 6 months. Green is going to be a positive for the economy, and we would call that a tailwind because it's pushing economic growth along. Yellow is a caution, and red is a headwind that acts as a brake on economic growth. So where we were at in December of 2008, we see a lot of red on the board. The economy is in serious trouble. The housing market is deep in the red, volatility is high, the global economic outlook is negative, and business spending is dropping. Now this chart looks at where we were for January of 2017. Now on this, you can see a lot more green on the board. The US economic outlook is good, consumer confidence is high, corporate profits are growing, and we see a lot more positive signs. Overall, on this chart, 16 of the 20 leading financial indicators reported positive or strengthening numbers. There is no red on this screen. Now we can take a look at where things are as of December 2017. The only negative on the board comes from geopolitical risk, and I think that's no surprise there. Our testy relationship with North Korea, the Russian collusion investigation, have really helped to keep that particular speedometer in red. But just as we were in January of 2017, 17 of the 20 speedometers on the screen are green. Now these, again, reflect our economy's strength and give a positive outlook. Throughout the year, corporate profits rose, the global economic outlook improved, and US economy outlook remained strong. The yellow gauges are areas where analysts do have some concerns, and we'll continue to watch for the developments there, especially over the next 3 to 6 months. And though there's still room for improvement in 2018, our economy reflects a strength and potential, which is especially stronger from where we were in 2008. Now, the past cannot predict the future, and financial markets don't always act in concert with the economy. However, barring some unexpected economic shocks, we're confident that economic growth will continue in 2018. Markets really have rallied since the presidential election, reaching one record high after another. But are investors too euphoric? Are equities overvalued? Let's examine the chart to see whether stocks are at a fair value. First of all, a PE ratio measures the difference between a company's price per share, or P, and its earnings per share, or E. So the higher the PE ratio, the greater the difference between what investors pay for a stock and what the company actually earns. So a high PE ratio means that stocks are relatively expensive compared to what they are earning per share. If you look at the middle dotted line on this chart, you'll see that an average PE ratio is about 16. So in other words, over the past 25 years, stocks have averaged a price per share of about 16 times their earnings per share. And in the Great Recession, the PE ratio was far below the average line, whereas it was high above the line during the dot-com boom. By December 31st of 2017, the PE ratio was at about 18.2, which is above the 25-year average, but still within one standard deviation of that average. So again, we've established that the PE ratio is a higher than historically average, but it's still within one standard deviation of this number. And if we look more closely at the context, we can see that the current PE is pretty normal for times when inflation is as low as it is right now. In fact, since 1871, anytime inflation has been between 1% and 2%, the S&P's PE ratio has been just over 20. So at our current low inflation levels, a PE ratio of 18.2 is actually not that high at all. So now that we've discussed 2017 performance and what economic factors may come into play in the year ahead, I'd like to get down into the details I'm sure you're all interested to hear about, which is predictions for the markets and the economy in 2018. As we discussed earlier in the presentation, inflation is below its 50-year average, but what will happen in 2018? So let's take a look at the numbers here. This data shows that the Consumer Price Index, or CPI, and reveals that prices are on the rise. Between December 2016 and December 2017, the CPI increased by 2.1%, which is above the Fed's target of 2%. And when you look at the less volatile core CPI, which doesn't include food and energy prices, remember, it increased by 1.8% in that same time period. The CPI-U is the CPI value for urban consumers, which excludes rural populations. So like we established earlier, inflation is increasing, but at a relatively reasonable rate. The difference comes when we look at the last 3 months of 2017, and during the fourth quarter, the CPI increased by 2.6% at an annualized rate. So what does that mean? It basically means that inflation increased as the year went on. In 2018, we do expect this trend to continue. Prices for housing and services have been increasing, and producer prices indicate that more inflation may be on the horizon. Some analysts even believe that inflation could hit 2.5% or even higher by the end of the year. So last December, the Federal Reserve raised interest rates for the third time in 2017, and currently their target interest rate is between 1.25% and 1.5%. The Fed currently predicts that if monetary policy changes occur gradually, then economic activity will expand at a moderate pace and the labor market conditions will remain strong. The Fed also said that they plan to increase rates 3 more times in 2018. Ultimately, rising interest rates are a sign that the economy is doing well. But what happens when interest rates rise? Well, let's check out the chart. So the yellow dotted line represents a 5% yield on a 10-year Treasury note. Now look at where the brown diamonds are. They're mostly clustered around the upper left and bottom middle. So this arrangement is showing us that when interest rates are below to rate increases. So in other words, history shows us that we may be able to expect the markets to rise as interest rates increase as long as they stay below the 5% rate. After the December 2017 meeting, the Fed released predictions for GDP and unemployment in 2018 and beyond. And as you can see, they predicted that the GDP will continue its steady, moderate growth, and they expect that unemployment will drop even further in the next few years, hitting 3.9% in 2018. So as of November 2017, the unemployment rate was 4.1%, which again, that's the lowest level we've seen since 2000. So with unemployment this low, wages typically rise in response. In this chart, the brown line is going to be the unemployment and the yellow line is wage growth. These two measures usually inversely relate. So when unemployment goes down, people can generally expect to earn more for their work. So given all these other predictions, what are the experts forecasting for domestic equities in 2018? Each year, various media outlets compile the S&P 500 price targets of Wall Street's top analysts. And let's take a look about what they have to say for the S&P 500 this year. So these targets are not ours, they're what experts are predicting. And as you can see, the 2018 estimates cover a 750-point range from 2,350 all the way up to 3,100. So this is just further proof that even experts often have differing opinions. But while they gave a wide range of results, one trend is consistent, and all but one strategist is predicting that the S&P 500 will continue to rise in 2018. And in fact, just days before the year started, a number of strategists increased their estimates for 2018 growth. Tobias Levkovich of Citigroup, who's listed here, he's one of those. So the strategists we've included here, their average estimate of 2,863 would be 7.1% growth in the S&P 500 for 2018. And these are really strong returns. I mean, they are less than half of the 19.4% we saw in 2017, but solid nonetheless. And of course, as we stated earlier in the presentation, we're not trying to foretell the future. You know, no one knows for sure what equities are going to do in 2018, and predictions from this stage are pretty foggy. However, these analysts' perspectives show that for the most part, optimism continues on Wall Street. And I know we've gone over a lot today, but if you just take away one detail from our presentation, just remember this: emotions have no place in investing. Over the past 9 years, we've weathered so many storms, from the Great Recession to global pandemics, terrorism, and well beyond. And after all of these tests and volatility, the markets continue to grow and create new opportunities. So let's take a look at this chart of stock market performance since 1980. The average year has about a 13.8% difference between its peak and low prices. And if you look at 2017, you'll see that we experienced hardly any variation at all. While the S&P 500 gained over 19% for the year, it only had a 3% intra-year decline. For 13 months, equities have not experienced a pullback of over 3%, which is the largest streak in its history. And when volatility is this low, it can be easy to forget about what fluctuating prices feel like. But we want you to remember that the larger intra-year declines are normal. And this is sort of what we saw at the first part of February here with that quick pullback of 10% and recovery. An average of 13.8% drop can feel unsettling in the moment, especially with the intra-year drops. However, the market has been positive in 29 out of the last 38 years. So moving forward, we do expect 2018 to bring continued growth to the economy, but volatility may also increase, which is, again, what we're starting to see. So, steps that you can take. What can you do in 2018 to move towards your family's goals? Well, here are some action steps. If something changes in your life or personal situation, keep us in the loop. You know, we want to hear about important family events like births and deaths, and we also want to know about any health issues, unemployment changes, financial developments such as an inheritance that might change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, please share your thoughts with us so that we can help you pursue the life that you most desire. On top of specific adjustments in your financial life, we also want to know if you experience any changes in your feelings about risk or if you have any concerns about the market environment. We're here to talk you through whatever financial questions, worries, excitements, goals that you may have. So we want to help you make informed choices and stay on track towards those goals. And finally, we also ask that you go over your estate documents and beneficiary designations and any other paperwork to make sure it's all up to date. A well-organized estate is one of the best gifts that you can give your family. So thank you for tuning in and being a part of our market forecast webinar. Thank you again for your time. Colby, do you have anything to add?
Nope, I don't. Thank you again, everybody. We really do appreciate it. Like I said earlier, please reach out if you have any questions, concerns, that sort of thing. We'd love to chat about all that information that probably seemed like a fire hydrant and a little bit how it pertains to you guys specifically and individually. So thanks again, and I hope you guys have a great rest of your Wednesday.
Thank you, everyone.